Good evening once again. Myself and Mr. Shiwaju are the two partners that will be doing justice to the syllabus of strategic financial management and for this diet. Any moment from now, I will share my scope of the syllabus with you. And of course, Mr. Shiwaju will also take you tomorrow. We will do the same thing. There are three of us, rather. Myself and Mr. Shiwaju are the guys that will be taking you the calculation part of strategic financial management, while Mr. Ali is the one that will take you the theoretical part, because the scope of the SFM has been adjusted to a large extent. You recall that sometime in May, around May 13 or thereabouts, ICAN released the new syllabus. And then for that purpose, the strategic financial management, some topics have been taken out of strategic financial management and given to the financial management. So, and then, of course, the case study, the corporate strategic management and ethics, okay, has been removed from skills level. And then the strategy part of it, the strategy, governance, and risk management aspect of the CSME has been embedded in the strategy financial management. Therefore, my other colleague, which is Mr. Ali, is the expert that will be doing justice to the syllabus, to that scope of the syllabus. It's about 20% of the syllabus. All right. So I will take you like 45% of the syllabus, while Mr. Shiwaju will take you, I will take 45, Mr. Shiwaju will take 35, and then Mr. Ali, 20% of the syllabus, making 100%. So without wasting more time, tonight I will give you the course outline, then we start the topic, the lecture proper. So there will be nothing like overview. I won't run you through all the scope I'll be taking you. So we have to move straight to the class. All right. So let me share my screen with you so that I'll be speaking on the same page. We are going to talk more as we proceed, but because I came late, so I can't, don't let me delay you further. Okay. Please let me know if you can see my screen.
Yes, we can see it, sir.
All right then, thank you. Yes, tomorrow by the grace of God, the group will be created. Then you are going to be added to it. The study material will then be shared from there. But for tonight, let's let the class begin. All right. So course outline. Adejuwan is my name. Okay. We have been chatting. So you can reach me on WhatsApp 081-8242-96 then 89. Then you can connect with me on LinkedIn. Just search for Adejuwan Dawood. So let's connect. All right then. So as far as my own scope is concerned, I'm going to take you our cost of capital. Okay. I will also take you our capital budgeting decision. We are going to be explaining the syllabus later on. Then, of course, part of the capital budgeting, we're also going to have free cash flow. We are going to discuss adjusted present value, very technical, adjusted present value, APV. Then we are going to have risk and uncertainty. Risk and uncertainty. Then finally, we are going to do merger and acquisition. Merger and acquisition, particularly business valuation. Okay. So these are my scope that I'll be taking you. Of course, the scope of, like I mentioned to you, the scope of strategic financial management has been reduced. Before, we used to have portfolio theory, capital asset pricing model, asset replacement decision, capital rationing, okay, corporate failure. All those topics have been removed from strategic financial management and given to financial management. But that notwithstanding, let's start. Now, within the next 1 minute, the first topic you are seeing here, which is cost of capital, we are going to run through this for the next 6 period at a minimum. It will take us 1 month plus, because cost of capital is pregnant and is fundamental to all the topics that are quantitative in strategic financial management. There's hardly any calculation you want to do in SFM that you are not going to need the knowledge of cost of capital. For some of you, of course, you did performance management, and then in that particular subject, you did capital budgeting. So when you are calculating NPV, IRR, you are just given cost of capital. How they arrive at the cost of capital, you don't know. So we are going to learn about how to calculate cost of capital. What are the purpose? What are the uses of cost of capital? So we discussed that. So like I said, it will take us for like 6 periods. Then capital budgeting, the same thing. That one will take us like a month. The free cash flow, the adjusted present value, I will match the two together. So like 2 periods, we complete that. Then risk and uncertainty, we need like 3 periods, okay, for us to be able to do justice to that. Then Baba and Baba, merger and acquisition is the most frequent topic that is being tested by ICAN. There is no diet since the year I know about ICAN. There's never been any diet that ICAN means business valuation question. So it's very important. It's very important and very valuable as far as this particular subject is concerned. So watch out for that. So we are going to start with cost of capital. Then what are we going to discuss under cost of capital? Please, you have to call my attention if I'm too fast or too slow, so that I want to be in between, not too far, not too slow, so that you can grab something. All right? So we are going to discuss, we are discussing our cost of capital. So like I said, I've promised you that I'm not going to give overview of each of them, and that's why we are going to the class straight. Now, under this, you will learn about the introduction. Okay? Introduction to cost of capital. We are going to learn about the importance of cost of capital. Then we talk about the categories of cost of capital, including traditional, weighted average cost of capital. We talk about projects specific cost of capital. Then we talk about weighted average cost of capital of the combined activities, which are called WACC. All right. So these are the scope of cost of capital that we are going to be discussing for the next 6 period. All right. So let's move on. Yes. What do you understand by cost of capital? Before I give you the definition, let me just give a little bit of highlight of what cost of capital is all about. So when you talk about a company, that means a company must have owners, All right. So, and the owners have put up their resources to finance the operation of the business with the expectation that when the business does well, they are going to earn a return on their investments. Therefore, the return on investment that the company will pay to the shareholders is a cost to the company because it is the company that is paying it to the shareholders. So it's a cost to them. Not only that, of course, that return on investment is in form of a dividend. It is also possible that the company might require finance for a project. Say, for example, a company wants to execute a project, but the required finance is not readily available. So the company may need to approach lenders or investors for loans. All right. So the loan that the company will borrow to finance the project is not for free. There will be interest attached. So that interest to the lender is a return on their, because they are also for the lender to have provided you with the loan. That means they are investing in your company. So the company is expected to pay interest on the loan borrowed. So when the providers of capital receive the interest, it will come in form of a return on their own investments. But to the company that is paying it, it's a cost. And that's why in your POL, profit or loss accounts, you will see interest expense immediately after profit before interest and tax. The next item will be for you to charge interest expense. So it's a cost, it's a cash outflow to the company. So again, the preference shareholders may also invest in the company. And then so in that case, the preference shareholders will be entitled to fixed dividend. So all these categories of investors are what we call providers of capital or suppliers of funds. So the return that the providers of capital will receive is a cost to the company, and that is what we are discussing, which is cost of capital. So to now put it in the right perspective, what do you understand by cost of capital? You can say cost of capital represents the compensation required by the providers of capital from their investment in a company. I repeat, cost of capital represents the compensation required by the providers or suppliers of capital, including the ordinary shareholders, preference shareholders, and debt holders from their investment in a company. The cost of capital is determined by the market forces of demand and supply. Okay? So, I repeat, cost of capital is determined by the market forces of demand and supply, depending on the perceived risk associated with the company, which means that the higher the risk associated with the company, the higher the cost of capital and vice versa. So if a company is considered to be too risky, then the cost of capital that the company will pay will also be high. But if investors think that the underlying risk of the company is low, then of course the cost of capital will also be low. Please, you see me just writing something that doesn't make sense on the screen. It's because I don't want my pen to go off. Because once it is idle for too long, it will go off. I have to restart again. Okay, then. So that's basically the introduction to cost of capital. Let me recap what I just said so far. I said cost of capital represents the compensation required by the providers of capital or the suppliers of funds, including the ordinary shareholders, preference shareholders, as well as the debt holders from their investments in a company. It is cost of capital is usually determined by the market forces of demand and supply, depending on the perceived risk associated with the company, which means that the higher the risk associated with the company, the higher the cost of capital that the company will pay, and vice versa. So that is the introduction to cost of capital. Let's talk about importance of cost of capital. What is the significance of cost of capital? Majorly, there are two key importance of cost of capital. Okay, importance of cost of capital. There are two major significance or uses of cost of capital. One is project evaluation. Project evaluation, I will explain. Then the second one is determining debt equity proportion. Debt equity proportion. Okay, let's talk about each of them. What do you mean by project evaluation? Now, cost of capital is essential when determining the financial viability of a project. Under project evaluation, when a company has identified investable opportunity, all right, that project will need to be evaluated in order to ascertain its financial viability. So the essence of evaluating a project is to know whether the project is financially viable. Therefore, when when appraising a project, cost of capital is needed to discount the future cash flow that the project will generate, all right, to its present value equivalent. You will recall that when you did capital budgeting under performance management, you calculated NPV. How do you calculate your NPV? You multiply the cash flow with the discount factor for you to get the present value of cash inflow. You less the present value of cash inflow from the present value of cash outflow. You have your NPV. Now, what we are saying here is that without cost of capital, you will not be able to evaluate the project, because if the project generates future cash flow, but you don't have cost of capital that you are going to use to discount it, you won't be able to determine the financial viability. So that is one of the uses, that is one of the importance of cost of capital. That is for project evaluation. Cost of capital is used for project evaluation. All right. So that is that one. Then the second one is determining debt equity proportion. In the capital structure of a company, when you talk about capital structure, the capital structure is the way and manner a company finances its operation. When you go to the statement of financial position of an ideal company, you will see how the company finances its operation. The sources of long-term financing include the ordinary share capital, debt capital, or preference share capital. These are long-term financing. All right. So each source of finance has its own underlying cost. Like I mentioned during my introduction, for the ordinary share capital, the cost associated with the ordinary share capital that the company will pay is the dividend to the shareholders. The cost associated with the preference share is the fixed dividend that the company will pay to the preference shareholders. The cost associated with the debt capital in form of bond, loan note, or debenture is the interest expense that the company will pay to the debt holders. So each source of finance in the capital structure has its own underlying cost. Therefore, the objective of the company is to minimize the overall cost of capital. So determining debt equity proportion will allow the company to know the percentage of equity and the percentage of debt to be carried in the capital structure, because you want to minimize your cost. All right. So if the dividend that the company will pay to the shareholders is lower relative to the interest expense that the company will pay to the debt holders, then the company may want more of equity relative to debt. So if debt is cheaper, if debt is cheaper than the equity, the cost of debt is cheaper than the cost of equity, then the company may want to want to invest more in the in debt. We want to borrow more money to finance its operation in order to minimize overall cost. So debt equity proportion or debt equity ratio, cost of capital, we enable the company to know the percentage of equity and debt to be carried in the capital structure in the balance sheet. So these are the two the two main importance of cost of capital. I repeat, the first one is that cost of capital is used to evaluate a project. Okay, you use cost of capital to evaluate a project using relevant investment appraisal technique like NPV, IRR, adjusted present value, modified internal rate of return. All right, whatever the techniques that you want to use. So you need cost of capital to evaluate a project. The second one is to determine, you use cost of capital to determine the debt equity proportion in order to minimize the overall cost of capital. So yeah, that's it. Let me know if you have any question for me before we move to the next item. Please, you have to ask me a question. I love to listen to you. Yes, and then whenever you want to ask your question, just raise your hand. All right. So when you raise your hand, then I will allow you to talk so that we don't talk randomly. Yes, go ahead.
Okay, sorry. Subsequently, I would do the hand raising, and thank you for the opportunity.
You're welcome.
Despite all of that, I just came into the lecture now. I was held up in traffic from work. So, please, may I ask what topic are we currently doing now?
Cost of capital.
Okay.
Yeah. Can you see my screen?
Yes, I can see it. I can.
Okay. So the topic we're having.
Importance of the cost of capital you just stated.
Okay.
So that was why I entered the class, and that was why I was asking of the topic.
Okay. So these are my scope that I'm going to take you during the course of this diet. These are the scope that I will take you. So I pick it one after. The first item we're discussing now is the cost of capital. So I've done the introduction, then I just finished the importance of cost of capital, and that's what I asked you to put forward your question so that I can quickly attend to it before we move to the next one. All right, no worries.
Okay, sir.
The video will be shared so that you have access to it. Okay, then. Yes, any other question? Okay, so if there's none, let's move on. The next item we want to discuss is categories of cost of capital. Let's talk about categories of cost of capital. Majorly, when you are asked to calculate cost of capital, what the examiner is saying is for you to calculate weighted average cost of capital. Like I mentioned to you the other time, that depending on the way the company finances its operation, and majorly there are three sources of long-term financing. Like I mentioned, ordinary share capital, preference share capital, and debt capital. Each of them has its own underlying cost. So you want to determine ordinary share capital is the same thing as equity. So you want to determine cost of equity. You want to determine cost of preference share. You want to determine cost of debt. So when you put all the three of them together, the average of the three of them is what is known as weighted average cost of capital. Now, this weighted average cost of capital can be calculated in different ways, and I've categorized it into three. One is traditional weighted average cost of capital. We also have project-specific cost of capital. Then lastly, we have weighted average cost of capital of the combined activity, which I termed as WACC. Now, we are going to take it one after the other. this traditional WACC will take off for the next 3 periods, okay? It will take us for the next 3 periods. Then, of course, project specific is just a period. Then, WACOCA is also a period. But let's see how it all work out. Okay, then, let's move on. Let's talk about traditional weighted average cost of capital. Now, when you want to calculate weighted average cost of capital, let me put it down, traditional. Excuse me. What's wrong with you? Okay. Now, when you want to calculate weighted average cost of capital, you are going to carry out, specifically, you will carry out 4 procedures. The first step, depending on the capital structure of the company, the first step is to calculate cost of equity. Calculate cost of equity. Then step 2, if in the question you are given preference share, then you need to calculate cost of preference share. Okay. KP. This one is KE. Then 3. Of course, it's also possible you may have debt in the capital structure. So you estimate, you calculate cost of debt, KD. Then step 4, you determine or estimate weighted average cost of capital. Let me write it out in full. Weighted average cost of capital, WACC. So these are the 4 procedures you are going to carry out anytime you want to calculate traditional WACC. Let me explain to you. Like I mentioned, whenever you are asked to calculate cost of capital, you have to be very careful. You don't rush. You have to identify from the question, what kind of cost of capital do you want to calculate? Is it traditional weighted average cost of capital? Is it project-specific cost of capital or weighted average cost of capital of the combined activities? Now, we started with traditional WACC. Therefore, when do you calculate traditional WACC? Because examiner can give you like 2 pages kind of a question or even more, and you are asked to calculate cost of capital. You must know the right cost of capital that you want to calculate. And that's what I'm taking my time to explain this. How would you know that you're supposed to calculate traditional WACC? The traditional WACC will be computed. Let me put it down for you. When to calculate traditional WACC. Okay. This will be computed. This will be computed when information on capital structure that is ordinary share capital, preference share, and debt capital, preference share and debt capital. Including their underlying costs are provided. So what am I trying to say here? If in a question you are given balance sheets, in that balance sheet, you can see ordinary share capital, preference share capital, and debt capital. Not only that, you're also given information as per dividend, both ordinary dividend and preference dividend. You're also given interest expense. So you need nobody to tell you that you are supposed to use traditional, you are supposed to calculate traditional WACC, because project specific and WACC is not concerned about capital structure. Those ones has nothing to do. Those ones have nothing to do with ordinary share capital, preference share capital, and stuff like that. So it is only traditional WACC that need that information. So, and that's what I'm taking my time to do, to tell you this, so that when you see question, an examiner is asking you to calculate cost of capital, you don't just rush and be doing it anyhow. You must understand which one do you want to calculate. So take note of that. Now that you know when to calculate traditional WACC, how do you then calculate it? And I've already showed you, these are the 4 procedures you are going to carry out whenever you want to calculate traditional WACC. The first item is to calculate cost of equity. Step 2, you calculate cost of preference share. Step 3, you calculate cost of debt. Then step 4, you calculate WACC. So let's take it one by one. Each of them has its own underlying concept. So let's talk about cost of equity. All right? So cost of equity, let's start from there. Denoted as KE. Please, if you need any, if you want to, if you need any clarification, just raise your hand, then I will attend to you. All right. Okay. What do you mean by cost of equity? You know, when I started the introduction, I mentioned to you that as a company, that a company must have owners. All right. The owners that have put up their resources to set up the company, they didn't do that for charity, because when you say company, the primary purpose of every business is to make profits. Therefore, the owners that set up the business, their intention ab initio is to earn return on their investments, because they believe that once the business does well at the end of the period, they will be able to earn a return on their investment. They will earn profits. So if that is the case, the owners of the business, the dividend that the company will pay to the owners of the business is a cost to the company, but to the owners is a return on their investment. Therefore, what do you mean by cost of equity? You can simply say cost of equity represents the minimum rate of return, the minimum required rate of return expected by the ordinary shareholders from their investments in the company. All right? Cost of equity represents the minimum required rate of return expected by the ordinary shareholders or equity holders from their investment in a company. It is also known as opportunity cost of capital, because the owners would have invested their money elsewhere, but they decide to invest it in the company. So the benefit that would have accrued to the owners from another venture, those benefits will not come again because it has been forgone. Therefore, That's why it is called opportunity cost of capital. So let me put it down for you. I said cost of equity represents the minimum. You are going to get your material tomorrow by the grace of God. So you'll be added to the group, then we share the material from there. All right? So this represents the minimum required rate of return expected by the ordinary share holders, or you can call it equity holders, from their investments in the company or in a company. Okay, so that's the definition of cost of equity. You can also call it dividend. Of course, when you say cost of equity, as a business concern, for the company to be able to maximize owner's equity value, the company must earn sufficient return that will cover the costs in order to create value for the business. All right. So like I said, a company must earn sufficient return to cover the cost in order to create value for the business. And every responsible organization, every responsible management must work, must strive, okay, to create value for the business by committing the financial resources of the business or of the company in a project that is capable of enhancing the value of the business. Because if the value of the business increase even by 1 naira, it means that the shareholders' worth will also increase by that 1 naira. All right. But when a company makes loss, of course, that will deplete. That will bring about diminution in the wealth of the owners. All right. That will reduce the wealth of the owners. So, as a responsible management, company must strive at all time to create value. All right. Okay, then. Now, how do you then estimate cost of equity? Like I mentioned, I said cost of equity is the minimum required rate of return that the company will pay to the ordinary shareholder, to the equity holders. I believe that is clear. Now, how do you then estimate cost of equity? Calculating cost of equity, or let me put it this way, methods. All right, methods of estimating cost of equity. Basically, there are 3 methods of calculating cost of equity. All right. 1, we have dividend valuation model. Okay, dividend valuation model. Then 2, we have capital asset pricing model. CAPIM. Then lastly, we have Miller and Modigliani. M&M. So, yes, these are the 3 methods of calculating cost of equity. When you get to theories of gearing, capital structure is a topic on its own. That's Mr. Chuadi will take you. So we talk more about Miller and Modigliani. All right. Again, when we get to adjusted present value, we are going to use the formula of M&M in calculating the cost of equity. Capital asset pricing model, of course, like I mentioned to you, it has been removed from the SFM and taken to the financial management. However, when we are calculating the project-specific cost of capital, we are going to need capital asset pricing model. All right? Now, let's pick it one after the other. Let's talk about dividend valuation model. Dividend valuation model. So before I go further, please tell me, do you have any question for me? Any question? So far, any question for me? Okay, if there's none, let me move on. Now, let's talk about dividend valuation model. Like I mentioned, the DVM is one of the methods of calculating cost of equity. When do you calculate cost of equity using dividend valuation model? But before that, let me put it down for you so that it will be clearer to you. Dividend valuation model is used to calculate cost of equity when information is used to calculate cost of equity when information on dividend and share price are given. Okay, so you use dividend valuation model to calculate cost of equity when you are given information on dividend and then share price. Okay, so for this purpose, cost of equity is calculated as the ratio of dividend to share price. Ratio of dividend to share price. All right. Depending on whether, let me include that. Depending on whether dividend will grow or remain constant to perpetuity. Okay, therefore, the first one, where dividend will remain constant, where there is no growth, in dividend payments, that is where dividend will remain constant. So, if dividend will not grow, the cost of equity will be calculated as current dividend divided by Ex-div share price multiplied by 100%. Now, let me explain. in this definition of, in this my explanation here, I mentioned to you that cost of equity is calculated as the ratio of dividend to share price. That is, you divide dividend by the share price. That will give you cost of equity, depending on whether there is growth in dividend payment or whether there is growth or no growth in dividend payment. Now, where there is no growth in dividend payment, it means that dividend will remain constant to perpetuity. As a result, the cost of equity will be computed as the dividend divided by Ex-div share price. I like to use Ex-div share price as my denominator. The reason being that when I put it like this, instead of me to just put share price, or I just put P, of course, when I do that, that may affect some students, because when I put Ex-div share price, your mind will be there to go and check if dividend has been paid or not. Because when calculating cost of equity, only the Ex-div share price can be used. I will explain to you what Ex-div share price is all about later on. But in most cases, examiner will give you Cum-div share price. You don't use Cum-div share price to calculate cost of equity. It has to be Ex-div share price. And that's what I love to use Ex-div share price as my denominator, instead of me to use the notion using SP or P or just share price. I like to put Ex-div share price, because this will call your attention to go and check from the question whether dividend has been paid or not. All right. So that's that. Now, it is where dividend will remain constant to perpetuity. Examiner may also ask you to calculate the market value of equity, especially when you get to business valuation. All right. Therefore, how do you calculate market value of equity where dividend will remain constant to perpetuity? So market value of equity. Now, when you talk about market value of equity, let me just explain it before I put down the formula. The market value of equity represents the present value of future cash flows discounted at the cost of equity or dividend yield. Now, when you talk about future cash flow, as far as cost of equity is concerned, market value of equity is concerned, the future cash flow simply means dividend, because it is the dividend that the shareholders will receive in the future at the end of the period. All right. So the market value of equity will represent the present value of future cash flow. That future cash flow, like I said, is the dividend discounted at the rate of return on equity, or discounted at the cost of equity, or discounted at the dividend yield. Is the same thing. All right. So what we are simply saying is that when you look at this formula of cost of equity, yes, Minister of Finance, I'm coming. I will answer you. So when you look at this cost of equity, you will see that current dividend divided by Ex-div share price. So this share price, this Ex-div share price is the market price per share. So that market price per share is what you have here as MVE, market value of equity. So when you now want to calculate the market value of equity, what you are supposed to do is to just cross multiply. All right. So, and that's what I said, that the market value of equity is the present value of future cash flow. That present value of future cash flow is the dividend. Okay. You then come here, you put current dividend. So now I said discounted at the rate of return on equity, or cost of equity, or dividend yield. So this KE is the cost of equity. I will not divide it by the cost of equity. So you can call it cost of equity, rate of return on equity, or dividend yield. So this is the formula for calculating market value of equity where dividend will remain constant to perpetuity. Okay. Yes. MOF, Minister of Finance, talk to me.
Thank you, sir.
You're welcome.
This statement you just made now,
Yep.
I wanted you to take it gradual at that point, and then please explain these terminologies again. Is sounding familiar and very strange at the same time.
Which one?
constant to perpetuate. I was writing it down, but unfortunately, I didn't get to that point because you were fast. When you were explaining market
Which
value
of
of
them I will
equity.
explain again? Which one?
Okay. Now, you were saying something that you put ex-div share price because it will tell us, it will draw our attention to go and check
Oh,
the
okay.
market price per share that was given to us. So at
Yeah.
that point, you were now saying something about the present value of future cash flow.
I was explaining market value of equity. Okay, let me just recap. Now, this is what
Okay.
I'm saying. I said that when you want to calculate cost of equity, it is simply the ratio of dividend to ex-div share price. And I said that I love to use ex-div share price instead of just put share price, or I can just say DO divided by P. All right. DO is the same thing as current dividend. P is the same thing as share price. But like I said, I love to use ex-div share price. Why? Because on the day of your examiner will rarely give you ex-div share price. In most cases, it will be cum-div share price. And I said I will explain to you what is ex-div, what is cum-div share price later on. So when you put ex-div share price, it will draw your attention to go back to the question and check whether dividend has been paid or not, because you don't use cum-div share price to calculate cost of equity. You use ex-div share price. And that's what I love to use, that Ex-div share price, so that students don't forget it. Because if you don't make adjustments, you just use the share price as given to you, use cum-div share price as given to you without adjusting it, you are going to get it wrong. And that's why you have to be very careful. Now, that is on one side. I also mentioned that market value of equity. I said that market value of equity represents the present value of future cash flow. The future cash flow is the future dividend that the company will pay to the shareholders. So that's the cash flow. So market value of equity represents the present value of future cash flow discounted at the rate of return on equity, or cost of equity, or dividend yield. And I said the rate of return on equity, cost of equity, dividend yield are the same thing. All right. So examiner can use they are the same thing. So, and this is the formula for calculating the market value of equity. So all you need to do is to just cross multiply, because the ex-div share price you are seeing there, okay, is the market value per share. You want to determine that market value per share, so simply cross multiply. Once you cross multiply, the dividend will remain the same. All right, dividend will remain the same. The ex-div share price will become the subject of the formula, then KE will come under. That's all. That's all. So, and I said this formula for market value of equity will be relevant when we get to business valuation. When we get to business valuation, when you want to value a business, we are going to need that. Okay, so that is that. Let's move on to the second one. Yes, MOF, Minister of Finance, are you fine now?
Thank you very much, sir. I'm okay.
Yeah, all right then. So the B part, where there's growth, where there is growth in dividend payments. Okay. How do you calculate cost of equity where there's growth in dividend payments? So cost of equity will be computed as the current dividend, which is DO. Let me use DO. I think I've defined that before. Let me just put it DO. That's current dividend. Multiply by, let me rewrite it. Multiply by 1 plus the growth rates divided by ex-div share price plus the growth rate. All of this multiplied by 100 over 1. So this is the formula for calculating cost of equity when there's growth in dividend payments. When there's growth in dividend payments. Now, you may be asked to calculate market value of equity where there's growth in dividend payment. Therefore, how do you do it? Similar to the one we did above. So all you're supposed to do to get the market value of equity where there's growth. So you pick the current dividend, you multiply with 1 plus G, you divide it by the cost of equity, KE, minus the growth rate, the G you are having here, minus the growth rate. So of course, whenever you are calculating market value, it will be in Naira. When you are calculating cost of equity, it will be in percentage. All right, please note that. So this is the formula for calculating market value of equity. In fact, this is the formula you are going to use on the day when you are calculating business valuation, for example. So this constant dividend is not common. What is common is the one with growth. All right, so watch out for that. Now, these are the formulas that you can use to calculate cost of equity using dividend valuation model. These are the most relevant formulas. Now, let's explain what is Ex-div share price, what is Cum-div share price. It's a concept in cost of capital. Ex-div and Cum-div. Share price. Okay. Let me know if you have any question for me. Anyone? Always raise your hand when you have any question. So let's move on. Now, what do you mean by Ex-div share price? The Ex-div share price represents the share price that excludes dividend. Ex-div, let me put it down. Ex-div, ex-dividend, let me write it in full. Ex-dividend share price represents the share price that excludes dividend. When calculating cost of equity, only Ex-div's share price is used. Therefore, if Cum-div share price is given, let me write that. It should be converted to Ex-div share price before calculating cost of equity. So that is that. Now, let me explain further. When you are given a question and you are asked to calculate cost of, examiner can tell you that the company has 10 million shares of 1 naira each, quoted at 3 naira, Cum-div. Okay, quoted at 3 naira Cum-div. once you hear cum-div in the question, it means that that share price given to you includes dividend. All right? So cum-div is the share price that includes dividend. But if you are told in the question that the company has 5 million shares or 10 million shares of 1 naira, the share price of the shares are quoted at 5 naira per share. The dividend was paid. The current dividend has been paid, or the current dividend was paid. Once the dividend has been paid, it means that the share price given to you is already ex-div share price. Okay, so share price, ex-div share price is the share price that excludes dividend. Okay, so, and it is only the ex-div share price that you can use to calculate your cost of equity. You don't use cum-div share price. So let's talk about cum-div. Cum-div. Cum-div simply means cumulative. Cumulative dividend. Cum-div share price. Okay. This is the share price that include dividend. The cum-div, let me write that. The cum-div share price should not be used to calculate cost of equity. Okay, the cum-div share price should not be used to calculate cost of equity. All right. So, like I mentioned in the first one, when cum-div share price is given, it should be converted to ex-div share price. So, you can then say ex-div share price is equal to cum-div. How do you convert cum-div share price to ex-div share price? So the difference between the cum-div share price and the current dividend will give you ex-div share price. So cum-div share price minus current dividend will give you the ex-div share price. So when you are calculating your cost of equity, you need to first of all go and make adjustments. Then you now put it in the formula. So that's very key. Otherwise, if you use cum-div to calculate cost of equity, that will be very wrong. Okay, that will be very wrong. So that is as per cum-div, and please watch out, is a concept as far as cost of equity is concerned. It's one of the concepts you must understand. Like in summary, what I just said here is that ex-div share price is the share price that excludes dividend, and it is only the ex-div share price that is used to calculate cost of equity. Then two, I said that cum-div share price is the share price that includes dividend. The cum-div share price is not used for calculating cost of equity. Hence, if cum-div share price is given to you, it should be converted to ex-div share price. How do you convert it? Simply deduct the current dividend from the cum-div share price, which will give you the ex-div share price. So that is as per that. Let's move on. Now, from the formula of the cost of equity, we have discussed ex-div share price as well as the cum-div share price. The last area we are going to touch base as far as cost of equity is concerned is to discuss the growth rate. You can see from the second formula for calculating cost of equity that we have growth. G is the growth rate. All right. G is let me define it, where where G equal to growth rate. All right. DO equal to current or latest dividend. Okay. Now you can see from the second formula of calculating cost of equity, you have growth rate. In most cases, examiner may not give to you the growth rate. How do you then estimate growth rate? So let's talk about that. Estimating growth rate. Estimating growth rates. G. Okay. Now, let me explain. You see, as investor, as shareholders, you want your investments to appreciate. Not only that, you want your return on investments to increase over time. No shareholder will expect to receive the same dividend received about a year ago in the current year. You will expect that your dividend would have increased no matter how little relative to what was earned in the previous year. But a company that is paying constant dividend, investor will not be motivated to invest more. But if the dividend is increasing over time, of course, you want to do more. You want to invest more. You want to put more funds into the business so that you can earn more return going forward. That's why you see Dangote almost every quarter. Dangote groups, once any of the Dangote groups announce a dividend, you see Dangote himself going, laughing going to the bank and earning so much billion every now and then. It's because of his level of investment in those companies within the Dangote groups. All right. So if the company is doing well, certainly investor will also be doing well because investor will earn more. And that's why you see even Femi Otodola in recent time, when he became the chairman of the First Bank, is it Oldco or whatever, he has invested more into the business. He has bought more shares in the business because the company is doing well and he is encouraged. So he believes that his money, his investment is safe and is in the safe hands. And that's why he's investing money in the business. So the more profitable is a company, the more the shareholders will also benefit. All right. So every shareholders will expect that their dividend will grow over time. Because if the dividend is constant, like for example, around the world, almost every country is experiencing inflation. If I earned a billion naira dividend last year, I expect that in 2025, that should have increased by no matter how little relative to what I earned in the previous year. Because of inflation, the purchasing power of money, the money that I received, the return I received last year, the value is not the same thing this year. So if I'm going to earn another dividend this year, the value, I should be able to earn more than what I earned last time. All right. So that is what we are talking about here as per the growth rate. Now, let me explain to you before I tell you how you are going to calculate your growth rate. Say, for example, in year one, an investor or a shareholder earned a dividend of 10 naira per share. Okay? In year two, the investor earned a dividend of 12 naira. In year three, the investor earned a dividend of 15 naira. You will notice that the dividend, okay, let me put it down. The dividend that this investor earned has increased from 10 naira in year 1 to 15 naira in year 2. Sorry, in year 3. Therefore, what is the percentage increase from 10 naira to 15 naira? That percentage increase is what we call growth rate. That's what we want to discuss, we want to calculate. So in a question, examiner may not give to you the growth rates. You are going to be given the history, the information about the dividend. So once you notice that the dividend is not the same thing across all relevant years, once the dividend is not the same thing, that means dividend has grown. So if dividend has grown, so you are the one that will calculate, because it is implied in the question. Once you see that dividend is different across different years, it means that dividend has grown. So if dividend has grown, you need to calculate the growth rate. You may be lucky, examiner may give it to you, but that is in rare case. All right, that is in rare, especially at this level, professional level. Once you are given the dividend pay for the relevant years, then and they are not the same thing, you should know that there is a growth that you need to calculate. Yes, Ufoma, talk to me.
Hello, sir.
Doctor, how are you doing?
Fine, sir. Good evening, sir.
Yeah, talk to me.
Sir, please, why is cost of capital or cost of capital calculated in a percentage? Why not absolute value?
Yes, you see that I said from the definition, we said that cost of capital is the compensation required by the providers of capital. Now, when you look at this cost of equity, for example, let me go there. When you look at this cost of equity, we say cost of equity is the minimum rate of return. Rate. When you talk about rate is always in percentage. All right? But if you say minimum required return is not rate, it should be in value. But when you talk about rate of return, that rate is a percentage. So that's why whenever you calculate cost of capital, it has to be in percentage. Did you get that, Rufoma?
Percentage of what? Let's say you want to get on a real case, as you want to get the value. What absolute value will you put that percent so that you get the actual cost?
Okay. Now, when you look at the formula for calculating the cost of equity, we said that cost of equity is the ratio of dividend to share price. When you say ratio is the same thing as rates. All right? Anything that is ratio is in percentage. You are dividing. When you say ratio, that means you are dividing something. When you say 1 divided by 2, is that not 0.5? So when you now move 0.5 is the same thing as 50%. Do you get, Former? When you are calculating cost, when you are calculating cost of equity, or when you are calculating cost of capital, it's always in percentage, not in value. All right. But when you are asked to calculate market value must always be in naira. You have to indicate the currency. It's always been in naira. All right. But when you are asked to calculate cost of capital, it must be in percentage, because it's a ratio. It's a rate of return. For example, now, when you want to invest, you as a prospective investor, you may say that, okay, for me to be able to commit my funds into this project, I must earn a return on my investments. Return on investment is in percentage. Your return on investment could be 10%, it could be 20%, it could be 20%, it could be 30%. That's what you expect to earn on your investments. So it is always in percentage. I hope that is clear. Okay, let's move on. The next one that we are currently discussing is the growth rates. So I've already explained to you why you are calculating growth rates, because investors generally will expect that the dividend earned over time will increase. No investor will not be happy if they are earning the same, if they are earning the same dividend over the years. So, and I also told you that the growth rates, of course, there are different ways in which you can estimate the growth rate. Let me just put that because of time. Yes, methods of calculating growth rates. Methods of calculating growth rates. Okay. Basically, there are two methods of calculating growth rates. One is historical pattern of dividend payments. Two is Gordon growth model. Historical pattern of dividend payments. I will explain later on. Then two, Gordon growth model. Please, you have to ensure you go through all of this before our next class. Because the thing will just be accumulating every day, every lecture. So it will be accumulating. So you have to ensure that you go through all of them. And that's why I'm taking my time to write it down. The reason why I'm writing like this is because you don't have access to the material, yes. So that's why going forward, even though I'll be writing, but not everything. All right. So let's move on. Okay, then, what do you mean by historical pattern of dividend payment? Let's talk about it. Historical, Emmanuel, hold on. Historical pattern of dividend payments. Now, what we are currently doing is to explain how to estimate growth, is to demonstrate for you how to estimate growth rates. And I told you that there are two different methods that you can use to calculate the growth rate. One is the historical pattern of dividend payment. Another one is the Gordon growth. Yes, Emmanuel, go ahead with your question.
Okay, if I must be realistic regarding this lecture,
Yep.
what you are explaining now is that you are like in a war front firing missile to harmless civilians, meaning that the points you are doling out is not something that some of us may be able to take in once if we can be able to get the recording for this particular lecture. Because to be honest, some of these many things, they are interesting, they are eye-opening, but it's something I really want to watch again. Not because I'm not following the class, but because I still want to just watch it again.
Okay.
Yes.
So what's your question? Or is it a concern you just raised?
It's a concern I just raised because I felt I would, if possible, after a class, maybe if you can get the lecture recordings and maybe drop it. Because for me, this night, I would like to still watch it again before going to bed. And this is just about 3 hours lectures, which some of us may not have we have the time to be able to rewatch again before the next lecture.
No worries. There's no cause for alarm. That's one of the beauties of online classes. The classes are recorded and it will be shared among the students. So at your own convenience, you can go over it 100 times, 1,000 times, as many times as you want. All right? So there's no cause for alarm. Okay, Iman?
Okay, sir.
You gave us
Thank
you. You're welcome. All right, then. So let's talk about historical pattern of dividend payments. This is also known as the averaging method. This is also known as the averaging. Let me write it. Averaging method. Okay. It is used. This is used, or it is used to calculate growth rates when the history of dividend payments is given. So you use the averaging method to calculate growth rate when you are given the history of dividend paid over the years. So for like I listed the other time, year 1, year 2, you pay dividend of 10 naira, 12 naira, and 15 naira. So the history of dividend paid in the first year, in the second year, and in the third year are given to you. So when you are given the patterns of dividend paid over the years, then that means you are supposed to calculate your growth rate using the averaging method. The formula below can be used. These are the formulas. There are two different formulas that you can use depending on the information available. So to calculate growth rates using historical pattern, G will be calculated as number of years minus 1 divided by, let me write that, minus 1. I'm coming Charity. So into square roots latest dividend divided by dividend paid in the first year, all minus 1. Okay. Where, let me put it here, where n equal to number of years dividend is paid. Okay. Then LD equal to the current year current dividend, current or latest dividend. Let me write it. Latest or current dividend. Then BD. This is base year dividend. Base year dividend or dividend paid. Dividend paid in the first year. Dividend paid in year 1. Okay. So that's that. I will explain later on when you should use this formula. Yes, Charity, talk to me. You raise hand.
Good evening, sir.
Good evening.
Please, can you scroll up? I want to see the definition of the historical pattern of. Yes, exactly. Thank you.
You're welcome. So can I go ahead with my talking while you are going through the definition? Charity?
Yes, sir. Go ahead, sir.
Okay. Now, when do you use the formula I just wrote there? Can I scroll down?
Yes, sir.
Charity? Okay, then. Now, when do you use this formula? Let me put it down for you. This is used This is used when the history of dividend paid in all relevant years are given. Okay, so that's when you use this formula. Every year, say for example, let me put it down for you. For example, so examiner can tell you that you may be given information. Say you have year, then the dividend paid for the respective year. Say you have year 1, year 2, year 3. For simplicity, let's say dividend paid in the first year is 15 naira. Okay. In the second year is 17 naira. In the third year is 20 naira. You will notice that dividend has increased from the first year of 15 naira to 20 naira in the third year. So when you can see that we're also given dividend, we are given information on the dividend paid across the 3 years. So when you are given this kind of information, then of course the formula to use to calculate the growth rate is what you have up here. G equal to n minus 1 into square root latest dividend divided by dividend paid in the first year. Now, if I want to calculate the growth rates now, based on the information, based on these hypothetical figures, I will just say G is equal to n minus 1. N is number of years dividend is paid. All right. So we have 3 years here. So that means n is equal to 3. I would then say 3 minus 1 into square root. Let me write that. Into square root. This is too close. Latest dividend. The current year is year 3. So 20 divided by dividend paid in the first year, which is BD. BD is dividend paid in the first year. So first year dividend is 15 naira divided by 15 or minus 1. Okay. So whatever I have, that will give me the growth rates. Using the calculator, I will get my answer. All right. So in this case, I can just say G is equal to 20 divided by 15. So I'll change it. If you know how to use second function in your calculator, so just use your calculator straight and get your answer. If not, you convert it to mathematically. So you can just say 20 divided by 15, then 3 minus 1 is equal to 2. So that will be raised to power 1 over 2, or minus 1. You get your answer. That's all. That's all you need to do. Okay. Now, so that is when you use the first formula. When the history, the amount of dividend paid for the respective years are given to you, then that's when you use the formula that you have there. The second formula is, let me just put it there, alternatively, G is equal to N into latest dividend divided by dividend paid in the first year, or minus 1. You will see that the two formulas, they look alike. It's almost the same thing. This formula and the one down here, they are almost the same thing, but there's a difference. There's a slight difference. This second one does not have minus 1. The first one has minus 1 after n. So this one does not have, this one is just n, not, there's no minus 1. But the first one has minus 1. That's different between the two. So when do you use the second one? Okay, let me put it down for you. This is used when the dividend paid, when the dividend paid in the first year, and current year are given. So the examiner will only give to you the first year dividend and the current year dividend. So when you are given that information, then in that case, of course, when you are given the dividend paid in the first year, that's also history. So examiner is telling you that, okay, this is how much dividend that was paid 2 years ago, or 3 years ago, or 4 years ago. That's history. All right. So in that case, because you are given the first year dividend paid and the current year dividend, so this is the appropriate formula you are expected to use. Examiner, for example, let me just put it down. For example, so usually examiner may express it like this. The dividend paid, 5 years ago is 10 naira. Why the current year dividend? Is 13 naira. Okay. Of course, other information will follow. So when you are given this kind of a thing, then of course, this is the formula that you are expected to use. In this case now, if I want to calculate my growth rate, I'll just say G is equal to N into ID divided by BD all minus 1, which is equal to N. In this case, what will be my N? Based on this example, what will be my N? N will be 5 years because number of years is 5 years. So dividend paid 5 years ago is 10 naira. So in this case, I'll just say 5 into square root. Latest dividend is 13 naira. That's the current year dividend. Dividend paid in the first year is 10 naira, all minus 1. I will carry my calculator, get the answer. That's it. So I believe this is clear now. There is no textbook that will demonstrate, that will tell you all of this, when to use the first, when to use the second, because I know the student pain points. I know how they struggle to get to understand some of these things. That's why I have to take it down to the lowest level. Please make good use of them. All right. When you get your golden book, you see all those information there. So let's move on. Now, this is how to calculate growth rate using historical pattern of dividend payment. The second one is the Gordon growth. So before I go to Gordon growth, let me know if you have any question for me, please. Yes, Minister of Finance, go ahead.
Thank you, sir. Sir, that first one, the historical pattern now, whatever we get as our answer, we will multiply by 100, right?
Yes, it has to be in 100%. Because that's you can see growth rates. Anything rates
Oh,
must be in percentage. All right.
thank you, sir.
You're welcome. So let's talk about Gordon growth more there. Okay. All right. So when do you use Gordon growth model to calculate growth rates? Okay, let me explain. The Gordon growth model is used for calculating growth rates. When information on earnings and capital employed are given. Okay, so when you are given profit after tax, earnings is the same thing as profit after tax. You know, in the statement of, in the income statement, in the statement of profit or loss, the top line item is the revenue. After revenue, you deduct the direct cost. Okay, then you have your gross profits. From the gross profits, you less your operating expenses. You have your profit before interest and tax. So you charge interest expense, you have profit before tax, you charge tax expense, you have profit after tax. That profit after tax is the same thing as earnings. So when you are given income statement in the question, at times examiner will not give to you, you may not be it may not be given as earnings. So that's what I'm explaining this, that profit after tax and earnings are the same thing. Then capital employed can be explained in several ways. It can mean capital employed can mean net assets, it can mean total assets, it can be described as debt plus equity. So depending on the information you are given in the question, but if you are given the capital employed directly in the question, so be it. If not given, there will be indication, there will be a direction that the examiner may want you to go. All right, but you have to know some of these things. Thank God you did in financial reporting, even in performance management. You did financial statement analysis, that is ratio analysis. So you know some of these things, how to calculate uh, return on investments and all of that, which is earnings divided by capital employed. So let's move on. Now, how do you calculate growth rates using Gordon growth? What are the formula? So G is calculated as return on capital employed multiplied by the retention rate. Okay. The return on investment, this is return on capital employed or return on investment. Okay. Then B is the retention rate. All right. So how do you then calculate? First thing first, when you want to calculate the growth rates using Gordon growth model, you need to first of all go and calculate the return on capital employed. You calculate the retention rate, then you now multiply the two together. So R is calculated as earnings. Like I said, earnings is the same thing as profit after tax divided by capital employed multiplied by 100%. Okay. So if in the question you are not given earnings, you may be given, if you are not given capital employed, you may have opening shareholders funds. You may also use opening shareholders fund, or R equal to earnings divided by opening shareholders fund. Okay, multiply by 100%. So that's another formula that you can use to calculate your return on capital employed. So like I mentioned, this capital employed, it could be total assets, it could be net assets, it could be equity plus debt, debt plus equity. So whatever it is, the information will be there in the question. It will show you the direction you are supposed to follow. So that is as per return on investments. Let's talk about retention rates. The retention rate is computed as earnings minus dividend divided by earnings. Multiply by 100 over 1. So the retention is the percentage of earnings that is retained in the business. You know, from the profit after tax that the company earned in a particular year, part of it will be paid out as dividend. Then why the remaining part will be retained in the business for growth and expansion. All right, for growth and expansion. So the part that is retained in the business is what we are calculating, which is the retention rate. Okay, so if in the question you are given earnings per share, so you then say earnings per share minus dividend per share over earnings per share multiply by 100%. So you get the same thing as your earnings. All right. Again, it is possible examiner may give to you payout ratio. If you are given dividend payout ratio and you are asked to calculate retention rate, then retention rate will be calculated as 1 minus dividend payout ratio. All right? 1 minus dividend payout ratio. Dividend, let me write it out. Dividend payout. Okay? Ratio. That's the DPR. All right. Okay. So once you are done calculating your retention rates as well as the return on investments, you can then proceed to calculate your growth rates. R multiplied by B, you get your answer, then you move on to calculating your cost of equity. So these are all the concepts you need to understand as far as cost of equity is concerned. So all these things, all the explanation I've been doing since, they relate to cost of equity. So they are all about cost of equity. So the next thing we are going to do is to have short examples. However, being the first lecture day, so let me use this one as an introduction. So in our subsequent class, so we are going to be doing all those small examples to explain the concept before we move to bigger questions. All right. So this is where we are going to call it a day. Let me know if you have any question for me before we close the class. Any question for me? Yes, Ifua is still on. Anthony, Charity, Emeka, Eshorame, Uju, Favor, Felix. Who is Galaxy A13? Galaxy. What's the name? What's your real name? Iboro is on. Kayode is on. Kevin, Michael. Minister of Finance, what's your real name?
Moses, sir.
Moses. Oh, you are Moses. I've forgotten the
Boy,
full name. Pardon?
boy, boy, sir.
Yes. Yeah. Okay. Then Michael, okay, Sonia. Glory is on. Olamide, Ufoma, Timileyin, Victor. Zoom user, I asked you for your real name the other time, did not tell me. Zoom user, what's your real name? Or are you attending by proxy? Charity, talk to me. You raise hand.
Sir, it's not a question, no, but I want to see the last formula of the B.
Okay. Is it this one?
Yes, sir.
This is well, okay. So, any question? So tomorrow, by the grace of God, Mr. Ashwaju will be having you on the SFM as well. All right. So when he comes, he will explain to you, I mean, we will show you his area of scope. And then again, as soon as we create the group tomorrow, by the grace of God, so we are going to share the course outline for SFM as well as the material so that you can have something to study with. Okay? So now, okay, let me leave it to the next class. Let's use today as an introduction so that I don't bombard you with too much information. All right. So thank you, everyone. I really appreciate your patience and understanding. We are going to meet again next week by the grace of God. Bye-bye,
Thank you,
everyone.
sir.
You're welcome.
Thank you, sir.
Thank you, sir.
You're welcome.
Thank you, sir.
Viju.
Yes,
Thank you,
sir.
sir.
Welcome. Lamide.
Yes, sir.
Good
Thank you,
night.
sir.
Thank you, sir.
Bye-bye.
Good night.
Good night, sir. Thank you, sir.
Thank you very much, sir.
You're welcome.
Mr.
Have a
You're
rest.
Juwon.
welcome. Mhm.